Have you ever wondered how a massive company, say Amazon, keeps track of every single thing you buy? Well, it all boils down to a really simple habit, something you might have even done yourself. Today, we're going to pull back the curtain on the business world's secret diary, the journal entry. And trust me, by the end of this, you'll see it's way, way easier than you think. Let's jump in.
So, think about it. Have you ever kept a diary? You just write down what happened. Woke up, had some coffee, went to work. It's just a simple log of your day. Well, guess what? Businesses do the exact same thing.
The only difference is, instead of writing about their day, they're writing about their money. And this money diary is so important it gets a special name, a journal. This is literally the official minute-by-minute story of every single penny that moves in or out of a company.
Okay, so how do you actually write in this thing? It all comes down to one simple but super powerful idea. I'm serious, if you get this one concept, you have unlocked the entire foundation of accounting.
Let's make this really easy. Just imagine your grandma gives you a crisp 100-rupee note. Awesome, right? What do? You probably run and stuff it straight into your piggy bank.
But let's pause and think about what just happened. Your piggy bank is now 100 rupees richer. Great, but what about your grandma's wallet? Well, it's 100 rupees lighter. That money didn't just magically appear out of thin air, right? It moved. It came from somewhere and went to somewhere else. And that, right there, is the biggest rule in all of finance. Every single money transaction, no exceptions ever, has two sides. A source and a destination. A from and a to. This is the key to everything.
Now, this whole idea of tracking both sides has a fancy-sounding name, the double entry system. But don't let that name fool you. Double just means we always record both sides of the story. That's it. Simple as that.
All right, so if there are two sides, how do we label them? Accountants came up with two special words for this, debit and credit. And I know, they can sound a little intimidating, but honestly, just think of them as simple labels, like left and right, or in and out.
The easiest way I've found to think about this is to picture two buckets. The debit bucket, which we shorten to DR, is for everything that comes in, and the credit bucket, or CR, is for everything that goes out. Comes in, goes out. That's the whole game.
And here's the magic that makes this whole system basically foolproof. The amount you put in the debit bucket and the amount you put in the credit bucket have to be exactly the same. They must always balance. It's the one rule you can never, ever break.
Okay, that makes sense. But how do you know which bucket to use for which thing, right? Well, luckily for us, accountants created a kind of cheat sheet. They're called the 3 golden rules, and they pretty much cover every single situation you could ever imagine.
So here they are, all laid out. Let's just walk through it real quick. First up, for personal accounts, that's just a fancy way of saying people or other companies. The rule is debit the receiver, credit the giver. Easy. Next, for real accounts, these are things you can actually touch, like cash or a laptop. You debit what comes in and you credit what goes out. And finally, for nominal accounts, think of these as the results, like sales or your electricity bill. You debit all your expenses and losses, and you credit all your incomes and gains. That's it. Those 3 rules are the entire playbook.
All right, that's enough theory. Let's actually put this to work. Let's meet Raj. He's just starting a new shop, and for the next few moments, we're going to be his accountants. Let's see how these rules actually work in the real world.
So, first transaction of the day, Raj takes 50,000 rupees of his own money and puts it into the business to get things started. To record this, all we have to do is follow a super simple 4-step recipe. Step 1, figure out the two sides. Step 2, classify them. Step 3, apply our golden rules. And step 4, write it all down. Let's do it. Okay, so steps 1 and 2 together. What are the 2 things involved here? Well, it's the cash itself, and it's Raj, the owner. Simple enough. Now let's classify them. Cash is a real thing. You can touch it, so that's a real account. And Raj is a person, so that's a personal account. Perfect. 2 steps down. Now for step 3, we just apply our rules. So for the real account, cash, is it coming into the business or going out? It's coming in. So the rule says debit what comes in. Done. Now for the personal account, Raj, is he giving the money or receiving it? He's the giver. So the rule says credit the giver. See that? The rules just tell you exactly what to do. And that brings us to the final step. Step 4. We just write it down. We debit the cash account with $50,000, and we credit the capital account, which is just the formal name for the money the owner puts in, with $50,000. And look at that. 50,000 in the debit column, 50,000 in the credit column. It's perfectly balanced.
So, if you only remember one thing from our little chat today, I want it to be this: that beautiful, unbreakable balance.
So let's do a super quick recap. A journal? It's just a money diary. Every single transaction has two sides. Debit is just a fancy word for in, and credit is a fancy word for out. And the number one most important rule of the entire game: debits always have to equal credits, period.
And that really is the whole secret. People think accounting is about memorizing 100 boring rules. It's not. It's about understanding one simple, elegant idea: that every transaction is just a story with two sides. Once you really get that, everything else just kind of clicks. But this leaves us with a really interesting puzzle, doesn't it? If every debit has an equal and opposite credit, and everything is always in perfect balance, then how does a business ever actually make a profit? How do they get ahead? That is a fantastic question, and one we'll tackle in our next explainer. Thanks for joining me.